This is Horizons Middle East and Africa, our top stories this morning. Asian stocks climb after U.S. and global equities hit fresh records, with investor sentiment boosted by the Fed's rate cut and its upbeat view of the economy. Ukrainian President Volodymyr Zelenskiy is proposing a referendum on whether to hand the Donbas region over to Russia. U.S. President Donald Trump has voiced his frustration with the pace of talks. And oil rallies from its lowest close in almost 2 months. We speak to Sara Vakhshouri, president and founder of SVB Energy International, on the outlook for the oil market heading into 2026. It's just gone past 9 a.m. across the Emirates, 7 a.m. here in Johannesburg. I'm Jennifer Zabasaja in for Jumana Bersechi. Happy Friday to you. And it has been quite a week with a number of central bank decisions, of course, including the Federal Reserve on Wednesday. And if we take a look at where markets are trading on this Friday, there's quite a lot of narratives that we're paying attention to when it comes to what traders are focused on. If we take a look at U.S. equity futures, a bit softer to start the day, down about 0.2% there. If we take a look at NASDAQ futures, Thursday was a bit of a mixed day on Wall Street, especially if we factor in those disappointing results from Oracle that fed into a lot of the downside that we saw across equity markets, especially the tech-heavy NASDAQ, as you can see there, and that adding in after-hours trading when we did get some results from Broadcom, clearly failing to meet investor expectations, as we can see NASDAQ futures down 0.2% there. The U.S. 10-year yield unchanged, though the yields were down across the curve on Thursday after we did get that Fed decision on Wednesday, and they were supported again by those higher than expected jobless claims numbers that we did get on Thursday from the U.S. The U.S. 10-year yield consolidated at about 4.1566 there. We also have the dollar up on the board, not doing too much, pointing slightly higher, though we are on track right now for the dollar to fall for a third week, its longest losing streak since August. That translating into some higher currencies for emerging markets. And silver right now, it is down ever so slightly, but what's been notable, and we've been pointing this out all throughout the week, is what we've been seeing from some of the price action from metals. Silver, though, is still continuing to be the standout, although we do see some softness, extending its high that we saw it reach earlier in the week above $63 an ounce there. And let's just bring you our terminal chart. We were talking about the tech-heavy NASDAQ, but what's been interesting for U.S. equities overall is just how the S&P is tracking, despite some of the downside that we are seeing from tech, and especially on Thursday. The S&P is still tracking up and about to close inching closer to another record high for the first time since October. So clearly, still, it appears there's some broadening out happening within that index. In particular, S&P is currently up 19% year to date. Let's, though, zoom in on how markets in Asia are faring. Min Lo is standing by in our Hong Kong studio, taking a closer look at that. Min, I see quite a bit of green on the screen there behind you.
That's right. We are closing the week on the right foot here. You can see the Asia Pacific benchmark up by close to 1%, set for the highest close in a month, and a sea of green across all markets, the Kospi, the Nikkei as well. We have the Fed behind us. We're now looking ahead to the BOJ rate decision, and all 50 economists surveyed by Bloomberg expecting a rate hike next week. So this is something to keep watching. We are also taking a look at what's happening in the Chinese market as well, because we are digesting the readout from the Central Economic Work Conference, a key policy meeting foreshadowing what are the policies that could be released next year. And overall, no surprise there. Mainly, we are seeing the same sort of policies when it comes to monetary and fiscal policy, consumption in focus as well, but lacking in detail when it comes to size and scope. There was mention of property stabilization measures, but I think economists are still a little bit disappointed and not clear about whether or not the latest measures are enough to turn around the housing sector, which has been in a slump for about 4 years now. But nevertheless, we are seeing the Chinese market joining in on this global rally, onshore underperforming a little bit, but still about close to 0.5% up. The yuan is pretty flat right now, but we are still pushing below the 706 level, and there still is a very bullish case for the yuan given how it has outperformed its Asian here so far, gaining against the yen, the Korean won, the Indian rupee, and of course a part of it is the US dollar weakness, but a lot of people are now watching to see whether it will break below the 7 level, and that could be a level to watch. If it breaks below that, we could see the continued appreciation of the yuan at a faster pace.
Thanks so much, Min Lo in Hong Kong for us. Great to have you, Min. Let's dig into some more market insights with Stephen Rees, the Middle East, North Africa, and Turkey Head of Investments at JP Morgan Private Bank, who's joining us from Dubai. Stephen, great to get you on. Let's just start where Min left off. We are seeing a bit of a global rally, albeit not the tech-heavy NASDAQ, but you've been quite bullish on the strength of U.S. equities. What is supporting that conviction that you have?
Yeah, it's really the strong earnings dynamic that we saw all year. I mean, we never gave up on the U.S. There was a lot of negative sentiment earlier this year that the U.S. growth story was over. Of course, all the uncertainty and negativity around the tariffs. But the reality is the U.S. earnings growth dynamic for corporates is very strong. And we think that will continue to be strong next year. And I think you made an important point earlier. It's not just the tech sector. We're actually seeing more encouraging growth coming from the other 493 companies where, a year ago, growth was running close to 3% for those non-tech sectors, and we're now actually seeing double digit. And so for 2026, we do like tech, but our views on the U.S. is you want to be much more diversified across other areas like industrials, financials, and we recently upgraded healthcare as well after some years of underperformance.
Do you see, as it pertains to the AI trade, potentially a bubble that might be burst soon, or is there some resiliency in the trade at this point?
Yeah, it's a great question. It's the question that came up every day this week on our Outlook tour. There are some areas that look a bit expensive, but the reality is we don't see the parallels to the dot-com bubble going back to the early 2000s. Yes, valuations are high, but in many cases, companies are positive free cash flow. They're growing earnings. And so, we're looking at the tech sector today, parts of it trading, around 30 times. Yes, it's elevated, but it's not, the 65 to 70 times that we saw during the internet crisis. So we advise clients to be cautious, to be selective. But the reality is we think the earnings growth is coming through, and so some of those high valuations are justified. And the theme is just too big and too present to avoid, and so you want to be selective and diversified across public and private markets, and it's one of our top ideas for next year.
What about as far as markets go? When we talked about the U.S., we were talking to Min about some of the Asian markets. Is that appealing to clients?
I think so. I think we see opportunities in Asia, but again, we want to be selective. We want to buy the pullbacks. 2026, we think, is going to be about increasing portfolio resiliency. So broadening out some of your exposure that you may have in the tech sector to other sectors that I mentioned, but also, adding uncorrelated streams of returns. So, hedge funds are top of our list. We see a lot of opportunity in infrastructure and also gold. And so Asia plays a part of that, but we think 2026 is a year you want to be very diversified and really focus on adding portfolio diversifiers that can help you manage and withstand some of that volatility that we expect to persist.
Stephen, let's talk about the big event of the week, which was, of course, the Fed. It's a quarter-point cut, as many people expected. But you and the team believe the Fed struck a bit of a dovish tone, as many investors do as well. What does that mean for 2026 and the path of monetary policy in 2026?
Yeah, I think the Fed has done exactly what we expected. They cut. I think what caught people by surprise and created a little bit of optimism here in the last few days is they actually increased the growth outlook and slightly reduced the inflation outlook. And so that has a lot of people excited. We're not overly dependent on the Fed. We actually are just expecting one more cut at some point in 2026. But the reality is a Fed cutting cycle, when growth is solid and likely going to accelerate a bit into next year, is generally supportive for risk assets. So yes, we have high valuations in equities, and therefore we really want to diversify next year and own other areas like hedge funds, infrastructure, fixed income. And I think one of the best ideas is just to be balanced, be multi-asset. The combination of equity and fixed income together, I think, can be quite powerful in terms of return potential next year.
Are your clients diversifying enough, or potentially are they still sitting on the sidelines a bit?
I think many are, but we do find many clients still overweight cash. And if you look at performance over the last 12 months, cash is actually the worst performer. We saw much better strength across risk assets. And so we're asking them to really rethink how much cash do they need, and are there better uses of that cash going forward? And we obviously think there are a lot of opportunities.
Potentially gold. We were talking about silver this week and some of the appreciation that we're seeing there, but gold slightly down today. But what's the appeal there?
Slightly down today, but we've seen a strong run this year. We actually still see quite a bit of upside in the next year. Our baseline target for gold is 5,300, so that's roughly 23–25% upside from current levels. The call for gold is really portfolio diversifier, a hedge against all of the policy uncertainty, all the concerns around Fed independence, and of course, I think inflation is the biggest risk to our positive outlook next year. If we're wrong and inflation starts to tick up again, I think it's going to be good to own gold in the portfolio. So we're asking our clients to stick with the gold that they bought this year. If you haven't done it yet, we don't think it's too late. We'll be selectively adding on pullbacks given our upside view into the end of next year.
Really great insights there. Stephen Rees, Middle East, North Africa, and Turkey Head of Investments at JP Morgan Private Bank. Stephen, thanks so much for joining us there in Dubai. Now, for a look at some of the other stories we're following today. Disney shares closed higher in the U.S. after the company announced it's licensing some of its iconic characters to OpenAI for use on the startup's video platform. Disney has also agreed to take a $1 billion stake in the startup. While the deal covers some of the firm's more famous characters, it does not include talent likeness or voices. And Broadcom shares fell in late trading after its sales outlook for the AI market failed to meet investor expectations. CEO Hock Tan said the company has a backlog of $73 billion in AI product orders that will be shipped over the next 6 quarters, a number that disappointed some investors. The company also held off on giving an annual AI revenue forecast, with Tan saying it was, quote, a moving target. Now, still ahead, President Volodymyr Zelenskiy is floating the idea of a referendum on whether to hand the Donbas region to Russia. More on what this means for the war and the pace of peace talks next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. Ukrainian President Volodymyr Zelenskiy has floated the prospect of allowing Ukrainians to vote on whether to hand the Donbas region to Russia. Ukrainian territory is at the center of ongoing discussions between Washington, Kyiv, and Moscow as negotiators inch towards a potential agreement to end the war. Joining me now is Tony Halpin, who leads Bloomberg's Russia Economy and Government reporting. Tony, what is the likelihood that Zelensky will actually follow through with this Donbas referendum?
Well, I think he's making an important point here that they can't just agree as president and members of his administration to give away territory on behalf of the Ukrainian people. That if there is some deal on the table that results in some sort of territorial concessions to Russia, that this will need some kind of endorsement by the population. And he said either in a referendum or elections. And in some ways, that's a response to pressure from the US about the need to hold presidential elections in Ukraine. He's basically saying, look, I'll put this on the table and it'll be for the Ukrainian people to decide. And if they endorse it, then obviously that's a different question than if I simply say, I'm ready to sign it, because that gives a sort of longer term perspective. The big unanswered question, of course, is what happens if the population votes against? That then leaves any agreement really in tatters.
And it really leaves a lot of the talks really to end the war at an impasse at this point. Right now, we're reporting that Trump is growing frustrated. Frederick Merz, though, is optimistic. How does this potentially impact the progress of some of the talks?
Yes, I think President Zelenskyy's point is that they really want to be very clear on the Ukrainian side what sort of security guarantees they're going to be given in any deal, because they don't want to see a return of Russian forces to Ukraine for a third time. President Trump has said, yes, they're willing to help provide security for Ukraine, but the US has been rather more vague about it. There are more talks planned over the weekend to try and hammer out some of those details. And I think the question of whether Trump is happy or unhappy is, at the moment, is just focused on President Zelenskyy's response. But ultimately, we still don't know what President Putin's response in Russia will be to an eventual agreement on the table. And so far, there's been much less pressure on Russia from the US to make concessions to reach an agreement. So far, all the focus is really on Zelensky. President Trump is, as he said, rather unhappy. He's been unhappy with Zelenskyy's responses so far. But there are genuine concerns in Ukraine that the US needs to answer, I think.
Yeah, still quite a bit of unknowns there. Tony Halpin, who leads Bloomberg's Russia economy and government reporting. Tony, thanks so much for joining us. Now, coming up, Uber is expecting to offer robotaxi services in more than 10 markets by the end of next year. We hear more from CEO Dara Khosrowshahi on the company's growth in Asia and the Middle East next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. Dubai's Roads and Transport Authority has launched a pilot public robotaxi service on the Uber app in collaboration with WeRide and Uber Technologies. That comes as CEO Dara Khosrowshahi says they expect to offer robotaxi services in more than 10 markets by the end of next year. Khosrowshahi spoke to us about that and why he's optimistic about their growth potential in Asia and the Middle East.
The APAC market and in particular the North Asia markets as well, they are huge growth markets for us. And if you look, for example, in the rideshare business, over 30% of our global first trips coming into the category come from the APAC region. The area is growing very quickly, including taxi as well, which is actually one of our newest products on the platform. So for me, coming here, seeing the teams, meeting with local business people and regulators, and talking about how we can be part of the future growth of the region is really what my agenda is.
Early this year, you also put out a statement on the robotaxi push as well.
Yes.
And so the Middle East and Asia were the markets for 2025 to launch. And we've seen, of course, that initial deployment in the Middle East already. What's happening on the Asia side?
Well, lots of discussions on the Asia side. I think what's really important is to set up a regulatory framework to go forward. For example, Hong Kong has various trials and pilots going on, and in many other markets, we're talking to regulators about how we can be a part of shaping rideshare and autonomous rideshare going forward. The technology is absolutely getting there. These are the robot driver. It doesn't get tired, doesn't get distracted. And we very much look forward to working with various authorities to introduce rideshare into the markets. We're now live in 4 markets now, as we speak, in the U.S. And in the Middle East. And I expect to be in 10-plus markets by next year. And we want those markets to be in the Asia-Pacific region as well.
Where then in Asia do you think is the most likely place?
We'll see. I think that certainly Japan has great potential. You know, with
they are behind on their regulation.
They are behind on their regulation, but I think that they also understand that with an aging population, there's a real need for transportation, not just in the large cities, but in the rural areas. And for example, I experienced that personally going to Kaga City. And where we have communal rideshare, and kind of took a rideshare trip and understood what the needs are there. So we're talking with various countries, regulatory authorities. I think Japan is going to be part of it. I certainly hope that Hong Kong is going to be a part of it. Australia, where we were just talking about, is a huge market for us. So we're having those dialogues, and I think that the picture will shape up over the next 2 years because the technology is definitely getting there.
Uber CEO Dara Khosrowshahi speaking exclusively to Bloomberg's Annabelle Drewlers there. And as the AI race between the U.S. and China intensifies, ASML says it's working to balance its business with Beijing while maintaining ties with Washington. CEO Christophe Fouquet told us exclusively in November that the question for Western governments is how far behind they want China to be in chip-making technology.
It's back to the race, right? So China will not accept to be cut off from technology. Right. If you have 1.4 billion people, you want to advance. So this is just a reality. Then I think the West could make the choice to continue to keep China behind by saying, well, we're not going to provide them the latest and greatest product, but we could provide the third, the fourth, or the fifth generation. Today, the product we ship to China are 8th generation behind our INA tool we talked about it. So we're quite far behind. The tool we ship to China, we were shipping to our customer in the Western world in 2013, 2014. So it's more than 10 years. And China, of course, is suffering from that. Their technology progress has slowed down. Now the question is, how far do you push that? Do we keep them behind 5, 10, 15 years? Not for me to decide. Or do we frustrate them to the point where they have no choice but to stop depending on Western technology, which for us it means on the long term that part of the trade is gone. They develop their own product, which they have done already for many things, and at some point of time they could even come back to us and sell those products. So I think it's mostly time to find the right balance between, the frustration, the delay, and what could be the consequence of that. And I think that the right question is most probably, how far behind do we want China to be?
And you can catch the full interview on Bloomberg Tech Europe later at 10:30 a.m. Dubai time, 6:30 a.m. if you're watching in London. And let's take a look at where your markets are trading on this Friday. It has been a busy week, as we mentioned. U.S. equity futures, S&P futures trading a bit sideways right now, but NASDAQ 100 futures notable, just given some of the caution that we've seen in the trade around tech, especially after some of those results that we got earlier in the week from Oracle, as well as after hours from Broadcom. NASDAQ futures pointing down. Though if we take a look at the picture across the Atlantic, Eurostock 50 futures actually pointing upwards about just over 0.4% there. Perhaps we are still seeing global equities rising as we were speaking to our min low, despite some of that caution with the AI trade more broadly. And coming up, South African President Cyril Ramaphosa urges his party to improve policy execution ahead of next year's pivotal local elections. We speak to Ziyanda Stuurman, advisor at Africa Practice, next. This is Bloomberg. This is Horizons Middle East and Africa. Our top stories this morning. Asian stocks climb after U.S. and global equities hit fresh records, with investor sentiment boosted by the Fed's rate cut and its upbeat view of the economy. Ukraine's Volodymyr Zelenskiy proposes a referendum on whether to hand the Donbas region to Russia. U.S. President Donald Trump voices his frustration with the pace of talks. And oil rallies from its lowest close in almost 2 months. We speak to the president and founder of SVB Energy International on the outlook for crude as we head into 2026. It's just gone past 9:30 a.m. across the Emirates, 7:30 a.m. here in Johannesburg. I'm Jennifer Zabasaja in for Jumana Bersechi. We finally made it to Friday, but still, let's take a look at where markets are trading right now, because, of course, we mentioned we did see a bit of positivity after that initial decision by the Fed earlier in the week, that quarter-point cut. But some of that was dampened by those disappointing results that we got from Oracle. And then an after-hours trade just yesterday, Broadcom also potentially failing to meet investor expectations, that dragging down NASDAQ. The tech-heavy NASDAQ, of course, down, pointing lower, just over 0.1% there. The U.S. 10-year yield slightly rising. It's still a bit unchanged if we take take a look at that. Though what's notable is what we have seen across the curve, especially since that Fed rate cut. We did see yields across the curve on Thursday dragging lower. That also got a bit of support from jobless claims that we got from the U.S. on Thursday, but the U.S. 10-year yield right now consolidated at about 4.16 there. The dollar also pointing slightly upwards, though if we take a look at what we've seen over the past few weeks, we're actually on track for a third straight week of declines for the dollar, potentially that feeding into other currencies, including emerging markets, which we'll speak to Min about in just a bit. And let's just finish on silver. We've talked quite a bit about gold, but we've also been focusing on some of the other metals, copper and silver included. It is pointing upwards and extending from its all-time high that it reached earlier in the week, above $63 an ounce there. And let's just bring you our terminal chart. We were talking about the tech-heavy NASDAQ earlier, but if we look at what we have seen from the S&P, continues to track upwards despite some of the early trading that we saw on Thursday in the red, and of course some of the caution that we are seeing feeding into at least tech names. Its first record close it got on Thursday, and potentially we continue to see that tracking upwards. S&P is currently up 19% year to date. Let's check in, though, on how markets in Asia are faring. Min Lo is in Hong Kong for us. Min, you are taking a look at Thai stocks. Give us a sense of what the price action looks there.
Yeah, we're taking a look at the Stock Exchange of Thailand. You can see the year-to-date performance here, down about 10%. We rarely check this market, but we're taking a look at this because Thailand is headed for early elections because the Prime Minister just dissolved the parliament after a key political party threatened to withdraw support for the current minority government. So an election will be held within 45 to 60 days, so as early as January. So something to keep an eye on. As you can see, it's been pretty volatile. Stocks rebounded back in June, but that momentum is pretty much fading now. It's been a very volatile year for Thailand, marked by Trump's tariffs, by political instability, by border skirmishes with Cambodia as well, and we are now set for the third straight year of decline in this stock market. But we're also taking stock of how the yuan is doing as we head towards the year end, and you can see that the yuan has been outperforming most of its Asian peers. It's been gaining against the dollar, but take a look at where it is. It's been gaining against the Korean won, the Indian rupee, the Taiwan dollar as well, and I think the Japanese yen as well. So really great performance so far, and there continues to be a bullish case for the yuan. If you look at how the trade balance has been improving, right, with very strong exports from China, you look at how fiscal policy is set to expand as well. So investors are looking for the yuan to go below the 7 per dollar handle potentially next year. So something to keep an eye on as well.
Fascinating stuff there. Min Lo in Hong Kong. Thanks so much, Min, for that insight. Now let's turn to South Africa. South African President Cyril Ramaphosa urged his party to improve policy execution as it looks to reclaim voter trust following its historic loss of its parliamentary majority last year. With local government elections set to take place as early as next November, the African National Congress was meeting to review its recent performance and assess progress on key commitments. Joining us now is Ziyanda Stuurman, advisor at Africa Practice. Ziyanda, great to have you here on set. I know we've spoken remotely before. I want to just start with some of the activity we're seeing from the Rand. We've spoken a lot about Rand depreciation. We're actually seeing the Rand quite strong. It's strongest in a few years. Do you attribute at least some of that to what we are seeing from the GNU and President Ramaphosa?
I think so. I think there's a relative amount of that Rand strength right now that's directly, I think, attributable to the fact that Ramaphosa's leadership of the ANC is probably the most unchallenged and uncontested it has been in a number of years at this point. Given the historic losses in the election last year, one would have thought going into this large internal ANC conference that there would be more contestation of him and his leadership, his policies, as well as the top 7 structure, the executive leadership of the ANC. That hasn't happened, and I think markets are reacting well to both the medium-term budget that was laid out about 3 or 4 weeks ago, as well as the fact that Ramaphosa in the ANC is strong, and so is the GNU as well.
And that was a bit of a different story just a few weeks ago. There were a lot of rumors swirling around about just how stable Ramaphosa's leadership of this party is. How should investors be interpreting some of those infighting? Is it put to rest now, would you say?
I think it definitely is. I think at this point, the simple fact that the NGC was convened, the first in a decade, the last was meant to have taken place but was cancelled because of COVID. I don't think that that meeting would have been convened if Ramaphosa did not feel that he was firmly in charge of the party, that he was firmly in charge of the policy and governance agenda. That came out, I think, very strongly during the 3 to 4 days, even where there was contestation from the South African Communist Party saying that they will push ahead to contest elections independently of the ANC. Ramaphosa came out very strongly and said if that's their decision, then the party would no longer be welcome in the ANC's own election strategy meetings. And many senior leaders would be forced to let go of their dual membership. I think this touches on somebody like Deputy Finance Minister David Masondo, who is both an ANC and an SACP member. This is Ramaphosa clearly drawing a line in the sand, saying if the SACP takes that decision, then the ANC is well within its rights to take a decision to really disband, I think, the broad idea of the tripartite alliance.
If we take a look at the agenda, Ziyanda, about just over 18 months, I think, of this GNU, the economy is still not growing as fast as it should be, especially an economy of this size. What have been some of the achievements and maybe still some room that, some progress that the party and the GNU need to expedite?
I mean, I think the main point of progress is around stability. There was an enormous amount of market volatility right before last year's elections. A lot of uncertainty in terms of which way coalition negotiations would go. So given that there's now relative stability, I think especially past the very contentious February budget process, now that that's been put to bed, I don't think we'll see a repeat of that next year in February. And really you have more of the GNU reaching a level of maturity that I think wasn't necessarily present six months ago, or even immediately after the coalition was put together. That being said, there really does need to be traction around what Ramaphosa himself turning South Africa into a construction site. There's lots of work to be done around port facilities, around road and rail facilities, and we have seen Transnet coming to the board just yesterday, signing a long delayed deal to concession about 50% ownership of the largest port terminal in the country. Just the other day, a 12 billion rand infrastructure bond sale going off successfully. So we really need to start seeing more traction and momentum around some of these big headline numbers and starting to literally see shovels and spades in the ground.
So then what does that mean for 2026? In the U.S., we talk about midterm elections. There's going to be local elections here. Does that make those elections that much more important?
I think that's broadly correct, both on the economic front, the macroeconomic front, as well as in terms of what we term service delivery. I think voters will expect to see more spending on public services, more improvement, particularly in cities like Johannesburg, Durban and Cape Town, which will be hyper-competitive going into next year's election. And I think voters will expect that of all of the parties across the GNU. The time for sort of excuses or the idea that the GNU is finding its feet, it's definitely over. At this point, there'll be, I think, a clear expectation of accelerated progress.
And I wanted to just ask you about the potential successors to Ramaphosa. How much was that a focus of this meeting?
It was a huge focus, I think. There's lots of jostling, lots of positioning, lots of posturing. We've heard a wide variety of names put out there. I think some of them a little bit more fantastical than others. But, you have Electricity Minister Khosrowshahi Ramaphosa throwing his hat into the ring. You have what sounds like a movement by Speaker of Parliament, Toko Didiza. She may be heading for leadership. And, of course, the names that come up over and over again, Deputy President Paul Mashatile and Secretary General Fikile Mbalula. I still think they're probably the two at the sort of forefront of this race. And to be fair to Mashatile, I think he's a prohibitive front runner. But this is also, just like the local elections will be competitive, that process to succeed Ramaphosa, I think, will also be deeply, deeply competitive.
But at least at this point in time, Ramaphosa seems to be a bit stable.
He's a man in charge.
Well, we'll leave it there with you. Ziyanda Stuurman, advisor at Africa Practice. Ziyanda, great to have you in studio with us. Thank you so much. Now, for a look at some of the other stories we're following today, the IMF said it's working hard to create the necessary conditions for a new finance program with Mozambique as the African nation faces immense pressures. Mozambique ended a prior arrangement 3 months after a new government took office to pursue a program that better reflected its priorities, but talks have dragged on. Tanzania's main opposition party has called for the annulment of October's presidential vote. Chadema's deputy leader, John Heche, said the election was, quote, neither free, fair, nor credible, and that President Samia Suluhu Hassan is an illegitimate, self-imposed ruler. Heche suggested formation of a transitional government to oversee constitutional reforms and fresh elections. Now, coming up, we speak to the president and founder of SVB Energy International on the outlook for the oil market as the IEA trims its estimates for a global supply surplus. That's next. This is Bloomberg. Oil has rallied from its lowest close in almost 2 months, buoyed by bullishness in broader financial markets. Yesterday, the International Energy Agency trimmed its estimates for a global oil supply surplus this year and next for the first time in several months. This as demand strengthens and output growth slows. Joining us now is Sara Vakhshouri, president and founder of SVB Energy International, joining us from Washington. Sara, thank you so much for being with us. Let's just take a look at some of the conflicting reports, it seems, that we got this week. How are you interpreting the messages that we got from the IEA, OPEC, and more broadly what we're seeing from the price action of oil?
Well, this trend has been going on for quite some times now, and if we just consider last year that we were having the same discussion in your program, the divide and the gap between IEA and OPEC forecast in terms of demand, particularly demand growth, was really a wide gap, and there was a huge confusion in the market. But we had, since in the past year, we had particularly a regular trend of revision from IEA data that they keep revising their global demand growth upward. So as of now that we're talking together, the gap between IEA and OPEC has reduced significantly, and IEA kind of caught up with OPEC. However, on the other side, if you look at OPEC, the revisions have been very minimal, to almost no revisions on their monthly basis. So again, we could, if you look at the both, comparing them together, we could say that IEA has been playing the catch-up game, and now the gap between them, it's much lower than last year. But we also had another interesting report and adjustment, and that's by the CNPC Chinese company, because obviously the China's demand for oil has been a point of question. IEA have seen and have been forecasting the Chinese demand, especially for this year, much lower than it actually used to be. It turned out to be, and CNPC also changed its forecast quite a bit. And now what they're looking is that longer term for higher demand for China. So basically, the curve has changed now in the revision, and as Chinese oil is peaking, according to this new revision, between 2025 to 2030. After that, we're not going to see a drop, but rather a plateau. So the curve has been changed. So we had some quite interesting revisions, but on the OPEC side, they have been steady on the demand side. On a supply side, also IEA did some revisions, and they reduced their expectation of supply increase because of the geopolitical factors, the ongoing war and conflict between Russia and Ukraine, and also the Venezuela issue.
Right. Do you think, Sara, potentially the market is underpricing some of the risks that those two instances potentially possess for oil more broadly?
Definitely, because the market, when we are talking about market, mostly we're talking about paper market, which is not a physical barrels, is a lot trading based on sentiments. And now we have algorithms that are highly sensitive to the news and headlines. And so there is this gap between the physical market and actual physical realities on the ground. So if you look at it, there are multiple factors. Yes, as we see that the expectation in the market and the forecast, like IEA, that of course has impact on the market sentiment, has revised its numbers toward a more bullish trend, but also we are having a much lower spare capacity when it comes to OPEC and OPEC plus production. The threat on physical infrastructure when it comes to Russia, which is a major supplier. We have another geopolitical factor in Venezuela, and at the same time, very low spare capacity cushion that we have. And these are all for the short term, because if we look at the long term, then the story is much different for the medium and long term.
Yeah, because there's also the added element of something like AI and data centers, which require more electricity demand. Sara, what does this all mean, though, for price volatility? We were mentioning what we're seeing right now, at least from Brent and WTI. How does this fare for 2026 or heading into 2026?
So I would say that we should give some credit to OPEC, because if you look at oil in compared to many other commodities in 2025, it had the much lower volatility given all the factors we had this year, geopolitical factors, tariffs, and lots of uncertainties over global economic growth. However, we could say that OPEC has been steadily both the impact on a sentiments when it comes to producing data and publishing data. They have been more in terms of data accuracy and how close our data with the realities in the market, but also the decisions that they have been taking in the past years and even this year. So we see that most of the OPEC decisions are mostly market-based and kind of giving certainty to the market when it comes to both sentiments and also the supply.
Yeah, and seeing Brent up just over 0.7% there. Sara Vakhshouri, thanks so much for staying up and joining us this morning. President and founder of SVB Energy International. Sara, thanks so much for your time. Now, coming up, it's been the worst year in a decade for Saudi's stock market. We'll dig into the details and the outlook for 2026 next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. Saudi Arabia's stock index has seen an 11% sell-off so far this year, its worst performance in a decade. The slump bucks a trend this year, which saw many emerging market equities roar back to life. Let's bring in Bloomberg's Farah Al-Bahrawi, who leads our coverage of EMEA equity markets, macro trends, and strategy. Farah, what's behind this performance? It's sort of, as we mentioned, bucks the trend that we're seeing globally.
Absolutely, Jen. Good morning. So you have the Tadawul All-Share Index slumping 11% this year. This is a year where we saw emerging markets beat the S&P 500. We saw them beat global markets. So really quite a staggering difference over there. There are many factors at play here. So firstly, it's as simple as the oil price. It's in the doldrums. The outlook isn't looking any better. And the Saudi economy continues to be highly tied to oil prices. And that's why you saw weakness in the Tadawul Tadawul there this year, but also the fact that the Saudi riyal is pegged to the dollar, so it does not get the same benefit that we've seen in other markets from a weaker dollar, especially for those dollar investors. And that's why you saw it among the world's worst performing benchmarks this year. The weakness is across the board. If you look at different sectors, every single sector has some name that's fallen. Among the top laggers, of course, is Aramco. Again, that's another oil story. And it's also about earnings growth that's not been as exciting as it was in other emerging markets. The momentum is not there. And overall, it's just not been a stellar year because of those foreign ownership limits that did give the market a boost and almost did erase yearly gains. But it seems like we're not going to get those as soon as possible. So that's another thing that's weighing on Saudi shares this year.
Does that portend poorly for 2026 for Saudi stocks?
That's what with the people that we spoke to for this story, investors, that's what they've said. So there just isn't a significant driver that would drive some short-term momentum in the Saudi stock market. As I said, the foreign ownership limit aspect is going to be really important. It needs to be lifted. That's something that clearly would excite the market, and we need to see some reforms on that front to get some more momentum. Valuations, they've come down, but they're still more expensive than other emerging market peers. So it's not enough to cause a re-rating. And next year, the oil outlook continues to still be quite muted. So as of now, earnings growth, also the outlook is much smaller. I think it's 3% for the Saudi market versus 13% for emerging markets, I guess. So even on an earnings front, it's really not that enticing for emerging market investors. Yeah.
Wow. Fascinating stuff there. Bloomberg's Farah Al-Bahrawi on Saudi stocks there. Farah, thanks so much for joining us. Great to have you on the show. That is it for Horizons Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. Stick with us for Daybreak Europe. This is Bloomberg.